On this video clip, we are going to practice bond payable issuance at the premium. So transaction on the January 1st, 2013, your company issued a premium bond that states the following certificate. The maturity is 3 years. The face value or par value, bond payable, the principal are the same concept, $100,000. And then the coupon rate is 12%, which is greater than market rate. That means that the $12,000 every year end, the company will pay in cash as a coupon payment. But the market rate just asked 10%. That's why the bond price is greater than the face value by 4,974. The company received this premium when they issue this bond. So the bond price, issued price, or the book value on the balance sheet is 104,974. But at the maturity, the company will pay back $100,000. That's the point of the premium bond. The company received 104,974 today, but when maturity comes, the company will pay back 100,000. Why? Because every year end, the company paid more interest than the market requirement. Market rate is 10%. Every year end, 2%. By 2%, the company paid more cash. That's why at maturity, they can just pay back $100,000 to the investor. Let's verify this transaction on the schedule first, and then convert these schedules on the journal entry. Okay? The book value when the company issued is 104,974, the actual issued price or the bond price. And then the book value is comprised of $100,000 and the 4,974, which is the bond premium. Okay? The interest expense. How do you get the interest expense in a year? Once the company borrowed 104,974, that is the financing amount that can be used to calculate the interest expense. So 104,974 times, what is the borrowing rate? Is that 12%? No, this 12% is only to calculate the coupon payment. The actual borrowing rate is still the market rate, the 10%. So 10%. So interest expense the company should recognize is 10,497. Then what amount is the cash amount regardless of what the market rate is? 12% from the face value. So 100,000 times 12% is $12,000 is coupon payments the company should pay in cash every year end. Then what is this difference? The interest expense and coupon payment, $1,503 is the difference between two. Why does this difference happen? Because interest expense the company recognized based on the market rate 10% is lower than the coupon payment of this. So the premium amount we recognize 4,974 in the first place should be reduced by this amount. Why? Because at the end of the maturity, the company will pay back not 104,974, but $100,000, which is the same value as the principal of $100,000. So let's add, which is minus. Then the book value has been reduced by the premium amortization amount. Then next year, the borrowing has been reduced to 103,471 times still a 10% market rate, because it is the actual borrowing and the borrowing rate. And then coupon payment is not relevant to the market rate. only the coupon rate is to calculate to measure the coupon payment. Then the difference between two, one more time, is the premium amortization. The company recognized 4,974, which is premium. The bond premium is the amount, is not the part of the interest expense. That is the amount the company they gave more the cash amount than interest expense. The 12,000, the coupon amount is not the interest expense. Actual interest expense $10,000. That's why we have been reduced. This premium from the book value. So 103 plus the premium amortization. The last year, the same process, 10% and 12,000. So the premium amortization also should be reduced 1818. Then guess what? There's a book value at maturity should be $100,000, which is same as the principal. Okay, so again, this bond, the schedule explaining what is the actual borrowings when the company issued the bond. 104,974 with the premium, but this premium was not actual interest. It should be reduced so that the company pay back $100,000 at maturity, the principal amount. Okay, let's convert the premium bond schedule, the information into the journal entry. Now, what account do we need on the credit side, which is each one, the bond payable when the company issued $100,000. And then, how much the company received cash? That's right, 104,974. Then the bond premium. We need now the bond premium account. We'll record the bond premium. It's not the contract account that reduces the bond payable. That is the accompanying account that increases the bond payable and arrives to the net bond payable. Okay, so the difference between the issued price and the bond payable is the bond premium. Now we'll reduce this bond premium every year end by the difference between the interest expense and the coupon payment. Okay, year one, the year coupon paid, interest expense recognized, the premium amortized. So cash, the company paid cash amount, which is coupon payment, and interest expense recognition. Now we have calculated, and then the difference between the interest expense and the cash, the coupon payment, is now the bond premium. Now I will put the positive. All this journal entry you should show as a positive number. So 15,003 on the debit account will be reducing the bond premium 4,974. Why? The bond premium is the company account with the bond payable, but the bond premium on the debit side means that reduced the bond premium. Okay, then next year we have the same transaction, the cash payment for the coupon, and the interest expense the second year, and the bond premium. Now the difference between two is now 1,653. The final year, the same transaction we need. Now 12,000, the coupon cash out. The interest expense, the last year, what do we need? Here we go. And then bond premium is 1818. Oh. Then, is that all? No, the company paid out the cash amount 100,000 at the maturity, and the bond payable. The bond payable now 100,000 should be cancelled out when the company paid out the principal plus the coupon payment. Now let's link the journal entry to the balance sheet and income statement. December 31st, 2013, starting from the January 1st transaction, the cash up by 104,974, the issued price, the bond payable always the face value 100,000, and the bond premium on the company account with the bond payable is 4,974. So the net book value of the bond payable is 104,974. Okay, now we got it. And then the December 31st to 2013, the cash out from the coupon payment and the interest expense minus on the income statement 10,497. So assuming that we don't have any other transaction, retained earning is accumulating the net income. Okay, and the bond premium we should reduce by amortization. So this bond premium should reduce by 15,003. So let's check if the balance out between the total asset and total liability and equity. Okay, we got it. First year transaction done and creating financial statement. Okay, again, when you create the second year, the next year balance sheet, we should always start the ending balance of the prior year as the beginning balance of the current year. So the cash, because the balance sheet is always cumulative, starting from your business to now. That's why we record as of December. As of means from the start of business to now. So we always should put the ending balance of the prior year as the beginning balance of the current year. So, but again, the income statement is not the cumulative concept. That's why it shows for the year end, just 1 year business activity is accumulated on the income statement. So the separately recorded, but the retained earning is accumulating the net income every year. Okay. The December 31st, 2014 transaction, the cash down by 12,000, and the interest expense out 10,347, and then it should be linked to the retained earning. Okay, then the bond premium we should reduce amortization. Now you may notice starting from the 104,974, now the December 31st, 2013, 103,471, now 101,818. So it has been reduced, and then final year it should be $100,000 before repayment. Again, this is because the company paid more cash than the interest expense. When they issue this bond, the issued price 104,974. This 4,974 premium is the cash amount exceeding the interest expense. That's why the company can pay back not 104,974 at maturity, but only $100,000 principal, because the company paid more the cash than the interest expense that the investors required. So let's make sure that if we match it between the total asset and total liability plus equity. So match it, second year. The final year, also we should start the ending balance of the prior year as its beginning balance of the current year on the balance sheet. Okay, the cash out. Now, the principal plus coupon payment, how much was that? The $112,000. Then the interest expense, the final year, 10,182 should be retained. And the retained earning we have been accumulating. And then the bond premium. Now the final year bond premium we have to amortize. So it should be okay. So that the company only pay back $100,000, not the $104,974 when the company issued. Okay, and then bond payable is no longer remained. Okay, so the cash on the total asset, total liability, and equity, we matched out. So please practice this exercise several times. It's a very important exercise to prepare the final exam and the quiz. So you may erase every cell in color and practice one more time. Okay. And then the bond payable issuance at par is very easy concept. I want you to practice yourself. So see you next video clip. Bye bye.